My name is Erica. I'm going to share my screen here and get us going. I am here with Mr. Josh Cooley, and we are here to talk to you today about really becoming the CEO of your business and how to really structure what you're doing when we worked so hard in the last week, and you guys will be working on the next few sessions on really how do you make your business, how do you earn business, how do you generate leads, how do you convert leads, how do we get the business? And then we kind of forget about this whole other part about now that we've made money, what do we do with it? And so what we're here to talk about is really how to structure your back end of your system on your financials. And I know this is a topic not many people love, or they kind of shy away from because they're like, I'm not good with money, or it'll all be okay. And I can tell you as somebody, I'm a 20-year veteran in this, and it wasn't until about 8 years ago that I got really serious about figuring out how do I take what I'm earning and really make it start working for me, so that I'm not doing real estate at 70 years old and pushing myself to an open house and figuring this out. And that really, when I made that shift, it really changed my life. And then I became super passionate about helping people to determine how do they find their path, and not just going from day-to-day selling and going through that roller coaster that we all go through in real estate. So I want to introduce here Mr. Josh Cooley as well. And Josh, you want to do a little intro on you?
I think you did. It was my name. I'm just here for the ride. Support you today. I know you have a lot.
You're just here for the ride.
Yes. Hello, everyone. Ask questions, but Erica, take it away. I got my pen and paper out.
Okay. All right. Awesome. Okay. So here we are. I'm a team leader for an EXP organization. I used to be an operating principal and team leader of KW Market Center, and has since sold that. And now I'm a broker and run a real estate team as well as a coach for RCC, which I love doing. And so, when I was running a brokerage, one of the best things I would say I learned was just really how to run it like a business. And both of my parents are real estate agents, real estate brokers. They've been in the industry 40 plus years. And I watched them struggle through the highs and lows that real estate can offer us, right? As far as just like 1 year we're doing awesome, and then like the next year we're like, what just happened to our business? And we set our lifestyles up. A lot of the agents set their lifestyles up so that they are living as they are making their money. So if they're having a great year, they're spending a lot of money. And what I really learned through that process was like, how do we start treating this like a business, and learning and understanding the fundamentals of just, we're here not just to sell real estate, but actually to be business owners. And that's when things are going to shift. So that's what we're going to go through today, is just really understanding expense management and budgets for success. We're going to understand reviewing our financials and our P&Ls. And then I'm also going to get into like the dreaded T word, which is taxes. And I will tell you why, and I don't want you to turn off, because it will probably be your biggest nugget of all day. I used to shy away from taxes, and I hated taxes, and I just thought they were this evil thing that I had to deal with, maybe next year, pay for taxes. And what I've learned in the last few years has just been mind-blowing on what I can do now as a real estate professional to be able to now build wealth for me and my family. So you want to stick around to the end. It's not going to be painful, but I'm going to teach you a few things about that. So let's dive in over here. So knowing your numbers, know your business. I think this is probably one of the biggest things I learned early on, is the numbers in your business, they tell a story. And I think you've got to stop and take a deep breath and go, okay, what are the numbers telling me about my business? And what I mean by that is really understanding, what numbers do I actually need to be looking at? What do I need to be paying attention to in my business when I am looking at things? Sometimes agents just go, well, I've got a P&L, and the P&L tells me like what I made, right? And they're like, I think I'm doing good. Am I not? Am I doing good? And they're not quite sure. So what we're looking at here, when we're talking about our numbers telling us a story, we're looking at what numbers should we actually be looking at. So when we're looking at numbers, we're obviously, this is a no-brainer. We're looking at our gross commission income. What is that telling us? But from there, we're also going to be looking at our volume, because as we're going through these different stages, and I'm not sure what part of the country you guys are coming from right now, but as we're looking at these different markets that we're in, we're seeing our volume shifting. And so that has a whole lot to play into, like, as you're doing your planning for next year. So if you're looking at your average sales price, maybe from this year, and going, well, that's what I'm going to do next year, it's probably not going to be the same. You probably want to make some adjustments to your volume. You're probably going to want to look at, even in our market, we're in Northern California, and I'm suggesting to everybody to do about a 20% reduction in their average sales price. So you're looking at it and going, okay, how is that going to equate to my volume? How many more homes do I now need to be selling if I'm really paying attention to what the average sales price is going to be, not maybe what it was? So those are some things you want to be looking at. You're going to be looking at your units closed, obviously. You're looking at your expenses. And this is something that is probably one of the most important pieces that we'll dive in today, is your expense management, because so many agents, they just all of a sudden they'll just go, I'm just spending money. And they don't really know that picking up, I call it, we're walking down the street and we just start picking up rocks. We're like, oh God, we don't have any business. So I'm gonna, I see something on Facebook where it's like, oh, get new leads with this. So I pick up a rock and I'm like, let's try this for a little bit. And then we go, oh, that didn't work after a month or so. And then we go down and we try to find another rock. And we keep picking up rocks all day long, not really knowing if they're making sense for our business. So we'll get into that a little bit. We're going to look at our net income. We're here to make a profit. Like every business should be making a profit. And what I want you to start thinking about is, if I was to be doing this as a job, not as my business or as my sales business, but if somebody was actually paying me to do this as a job, what would I be doing? What would I be wanting to make? What would I be wanting to take home to my household and be saving for my goals, for my future, for my retirement, for paying off debt, things like that. So we'll get into that. We want to be looking at how much money do we have in the bank? And do we have cash reserves? Do we understand what our budgets need to look like? And then do we have money for cash reserves for those months where we are having maybe a shift in the market and we're not back to selling, 4 or 5 homes a month, and we're going, okay, gosh, now I only have one that's in escrow, right? My pipeline's kind of dried up. What does that look like? Do I have enough ability to not freak out at that point or put things on credit cards? And what does that look like? So we'll get into that. We're going to talk about saving for taxes as well as saving for investments. So I love to look at taxes as more of a strategy on how do we build wealth. So we'll get into that. And then understanding the tax code to help you invest smarter. So let's dive in here. And we're going to look at a quick financial assessment. So what I want you to do is just take a quick moment, and as you're evaluating this, and don't get frustrated or anything that you're like, gosh, I don't have any of these. This is the building process. So this took me probably, I would say honestly, probably 6 years of creating different habits. And when I say habits, that's really a true thing, is creating habits around my money and the way that I think about money. So as we're going through and you're looking at your quick financial assessment, I want you to ask yourself these questions. And it's not good or bad. I just want you to know kind of a benchmark of where you're at and where you need to be going to really be able to treat this like a business. So first question is do I use a profit and loss statement? Do I review it monthly? Yes or no? Do I use a budget versus actual statement and review it monthly? And I'm going to camp on this for a second. A budget and actuals. So as we are doing our business planning, one of the things we really encourage you to do is to put together that business budget, right? And so a profit and loss statement, what it does is it tells us what we made and tells us what we spent. It doesn't tell us what we intended to make or what we intended to spend. It just gives us like actuals, right? So a budget versus actuals is saying, as we're looking at our planning right now, we're going into the planning season right now, we're going, okay, if we have a budget and we're saying this is what we want to be spending on lead generation, this is what we want to be spending on salaries, this is what we want to be spending on, furnishings. If we know we need to buy new computers, new phones, new whatever, new laptops, anything like that, we're being really intentional with everything that we're intending to do next year and writing that down and having clarity with that. And then what a budget versus actuals is doing is saying, hey, how far off am I on that? Like, did I actually spend that much, or did I way overspend in that category? What was I planning on spending and what did I actually spend? Because what happens, especially as we're going into a shifting market like we are right now, is that sometimes our income will come down. We don't even realize it until maybe 3 months later, is that our income has shifted off of our goals. And then we're keeping our expenses at the same ratio as when we were making maybe twice as much money. So our net profitability tends to decrease significantly. And so what we're really wanting to do here is look at, are we making as much money as we thought we were? And are we spending as much money as we were planning on? And if either one of those is out of line, then we're making adjustments to either one of those. Either we got to go, hey, we got to go and really double down on our lead generation, get more income coming in, or where could we cut some expenses that we don't necessarily need in order to move forward. So that's a huge one that really changed our financial picture, was to look at that budget versus actuals, so that I was really clear on, I was so passionate about taking home what I wanted to take home to my family and for our financial goals and for our wealth building, that it was a non-negotiable to shift either one of those. So it was like, if I was off, I had to either go get some more business somewhere, or I needed to cut expenses so that my net profitability was the same. Do we have separate bank accounts for our business and personal expenses? This is a huge one. A lot of people, a lot of agents, especially solo agents, when they're getting started, they don't treat their business separate from their personal. It's all commingled. And this is one thing that when you really start treating it like a business, you get to see what your business is actually doing versus what we're assuming it's doing. Numbers, they tell a story. What we tell ourselves in our head sometimes is the emotion that comes behind the money, or behind the expenses, or behind the income. And by looking at this stuff monthly, that's really where you're going to see some real gold there, is figuring out what's actually happening in your business, just versus what's emotionally happening in your business. Do we know what our monthly business budget is? Do I know what my personal budget is? And do I have a system to stick with it? Do I pay myself a salary? That's a huge one. How often do I review my money? What is my net worth? And that's a big one right there. What's your net worth? I mean, a lot of times agents will have great years and they'll be like, oh my gosh, I made all this money and it's amazing. And then a lot of times you've got the income creep and you've got the expense creep, especially on the personal side. And so one of the things that I love really working with agents on is helping them understand how to keep, as the income's going up, how do we keep expenses that for the most part can stay fixed? Sometimes we've got variable expenses with if we're doing more business, we're going to have more signs and more, listing, more photography and more videography and things like that that are associated with per transaction events. But instead of having our income and our expense going up at the same time, so then all of a sudden if the income starts to come down, our expense isn't here, and then we start going this way and we start getting ourselves back into debt. So looking at that and going, what's my net worth? Like how am I building assets that can create some passive income, so I don't have to always be looking at where's my next deal. As soon as I close that deal, I've got to go look for the next one. Net worth is a huge piece. Do I have a separate account for my taxes? Do I have a CPA that I meet with every quarter to evaluate my tax position? And this is a huge shift in what normally gets taught to agents, where the mentality is go pay your quarterly taxes, right? Like go figure out what your quarterly taxes is. Well, that's always based on last year's taxable events, right? Like, so last year, let's say you brought in 200,000 and you're paying quarterly based on what you did last year. If your income is shifted or your expenses have shifted this year, you're not going to be paying as much in quarterly taxes. You really need to be working with a CPA. And this is probably one of the biggest things that I can, if I can get anything through with you today, is to find a CPA that is versed well in real estate and being a real estate professional, and use them as a strategist to really help you build your business and build your wealth. Because learning and understanding taxes, it was something I never wanted to do, but once you understand the benefits you can get out of it, you're going to say, wow, I literally probably given away like well over between probably $1 to $2 million in taxes in the last 10 years that I could have been putting towards wealth building activities. And I'll show you how to do that. Do I pay quarterly taxes? So looking at that and just understanding what that quarterly tax obligation does look like. Am I clear on when I want to retire and how much I will need for retirement? How many agents do we know that don't have any system set up for retirement? That's a huge one. And then do I have a clear plan on how to get the amount needed for retirement? So as we ask ourselves these questions, I think it's so important that we're not only paying attention in this series on how to go out and get business, but it's now how to get, once we've gotten the business, now how to take care of the money and use it as a vessel for building wealth for you. So if you've answered no to any of these things, I want you guys to start thinking about, we're going to have something at the end where it's like an action plan of like, how can I start this process? And again, this is going to be a process, because learning and educating yourself on money and taxes and finances does take some practice. So we're going to jump into it real quick and just talk about the flow of money. So flow of money, I mean, pretty basic. Flow of money is what comes in, that's our income. What goes out, those are our expenses. And then what do we have left over? Pretty simple, right? What I want us to look at here is what's going in. So normally we've got two different sets of expenses that maybe are realized and not realized. So something that a lot of agents don't pay attention to, they base a lot of their ideas in their head on what they make based on what their total income is, their GCI, their check. Okay, so we have a $10,000 check. Out of that $10,000 check, you're going to have what's called cost of sales. And this is for pretty much every agent out there. Yeah, if you're with a brokerage, you're going to have any kind of a brokerage fee, a franchise fee. If you're a team, you're going to also have money that would be coming out. This is all the money that's going to come out before you get your check. Okay, so think about referral fees would go in there. Anything, I mean, you're going to have anything with, sorry, this is our what goes out, commissions, royalty fees, commissions, splits, buyer's agents, showing agents, referral fees. All those things come out before you get your check here. And then we're going to have what's called operational expenses. So costs of running your business. One of the things that agents don't pay attention to though, is like I was coaching a team, and once we started looking at their numbers, because we couldn't quite figure out why they were not bringing home as much money. And they were so heavy on referrals, and they didn't realize, that they literally were spending out of their GCI that they were paying out their 25% referrals. And that was costing them. I mean, yes, it's a source of business, but when they weren't allocating that in their budget, and that became almost about a $60,000 expense that year for referral fees that they had paid out. So we just needed to make some adjustments to their budget so that they had that built in there and knew that that was going to be part of their expenses before they got their income. Because we were trying to kind of figure out how do we get this nice net number. So paying attention to that's really, really important. Looking at your operating expenses, obviously you've got different expenses. It's all the costs of running your business. And we all have a ton of those, and we can write off a ton of those, which is great as self-employed agents. And so you're looking at all of these items and putting them though in categories that are really clean and really clear. So we don't have 34 categories. We've just got a few, and we're really clear on what's going into each category. So we're consistently putting them and organizing them the same way each time. So once we've done that, and then we have what's left over. So that's our obviously our net income or our profitability. So what should we be doing with our profitability? We can be growing the company, we can be investing for retirement. And then some of you will say, well, that's what I live on, right? Well, what we're going to try to teach you is how to really do it smart and really start paying yourself a salary. So Josh, I'm going to have you jump in here.
All
And I
right.
want you to just kind of talk about a little bit about what your experience has been in coaching agents on kind of some pushback that they get and when we get to this space about really paying themselves a salary and really treating this like a business. Because this is when we're looking at this here, this is our typical agent's flow of money, right? They get their commission check, it goes into their personal bank account, they buy something new because they're like, yeah, I closed a deal, it's great. I got some money in my account, I feel good. Pay off my credit cards, I put all my business stuff on my credit cards. And they typically have no business savings, no savings for taxes. Usually that's happening in the following October is what a lot of agents do. And they're not investing in anything. Are you seeing that? I mean, tell me a little bit about when you're coaching clients and you guys are talking about money. Is this something that's pretty typical that you see?
It is. By design, I think realtors are great with people, high energy, little squirrely, which is fine. Just be aware of it. With the agreement to yourself to run a business based on the numbers, right? And you looking back at them comes with right here, right? You got to be able to put yourself in a habit loop of taking care of your money first. Having two separate accounts is really, really important in this. Paying yourself monthly and pay yourself an amount you can live on, right? I see had a couple clients that were giving themselves pretty big draws in the last market, a couple years. And we talked about what that meant toward what's the opportunity cost, right? We're missing investment money down line. We don't need fancy cars and things like that. Mitch Palmer from Palmer Bookkeeping will be coming on. I've used Mitch for, oh boy, 8 years for personal, all of our rentals and the business. And so you can look at your personal profit and loss and see where you're at, comparing it to what the money is you're making. But there's a slide after this, correct?
Yes, right here. So this is kind of our smart agents flow of money. Just to Josh's point, excuse me, looking at it, like how can we start creating different accounts and different things where we can start allocating our funds in different places, just like Josh is saying. So you want to walk them through this here?
Sure. So there's a word that it takes, or a little bit of backbone, to be able to do this. Erica, what would you say that word is?
I use the word discipline. But I always say discipline equals freedom, because it's like that was kind of my main word that I learned. Discipline equals freedom. Right. And in 2008, when the market crashed, I didn't have discipline. We had a lot of fun with our money, and then that lack of discipline created so much anxiety and so much stress when the market shifted. And going into this market now that I have all these things set up, I'm like, yeah, we're good. We're going to be just fine. Like, I'm not worried about it at all. You know, so that discipline actually now created it, and it was painful. The discipline was painful, and getting to that place. Now I can't even imagine doing any other way.
Yeah, I remember 3 years in a row, years ago, that discipline was a word I wrote on a sticky note. I always have sticky notes in my pocket, and put it on the mirror every morning. Discipline, starting there, like making the decision to track your numbers takes discipline. And then once you get that down, you can come in here and say, okay, I am not just working paycheck to paycheck, or I'm not just working to sell the most homes. I am working for that why, that in coaching we discover and rediscover all the time. So this flow chart compared to the other, you get your commission check, it goes straight into your business account, right? Business savings account. Just look at the differences here on the bottom. You know, pay personal account a salary, goes in automatic account. Pay your business expenses, and fund an investment. Hopefully, and then you get to the point, if it's not right now, that investments become a part of your why and what gets you out of bed. The reserves, I hope you have reserves right now. This is the market we keep those in. Some people are taking, you know, really hunkering down. Some people are taking this market as an opportunity to spend more and grow, right? And the difference is who is prepared, right? Obviously, we have to pay taxes. Erica has a stay tuned to the end. Erica blew my mind. Yeah, CPA is worth it for sure. State and federal taxes we got to pay, obviously, and then investing is where we go. So discipline is the word above this whole course today. If you don't have the discipline to look back at your numbers, how are you running your business, right? I'll tell you right now that, what did I write down? It's funny to me at the time. Oh, awesome and energy is not a business strategy. I've got several awesome people and awesome clients that's like, how did you do that? Yeah, I'm awesome. Well, I know you're awesome, but how did you do that? Oh, I don't know. So don't be that person.
Yeah, I don't know, and I can't replicate it. So that's the goal. Like, can you replicate this? Absolutely. So as an agent, sometimes it feels overwhelming that you don't quite know where to start, right? Because you start looking at this and you're like, how do I even pay myself a salary? I can barely, like, you know, pay my MLS dues sometimes, or like, I'm not quite even sure where I'm making money and where things are going. It's a process, and learning this is a discipline. And it like, I used to literally take on my Friday mornings, I'd take Friday mornings for about 3 hours, and I'd either learn something about finances, I'd read a book about finances, and then I'd always do I had everything in Quicken, so I did it myself. I wouldn't necessarily recommend that, but it gave me an opportunity to really touch all my money every week, so that I knew exactly where I was spending my money, and I could shift pretty quickly if I felt myself overspending. But I think, you know, to a lot of, you know, Josh's point, he's got people that bookkeepers. I mean, that's where we're at now. We've got bookkeepers, but when I started, I did it every week by myself, you know, with myself, and it was on my calendar. So, but that's created a huge opportunity for my family and I.
Yes, and I'm going to ask for a favor. First, give a gold bar and I'm taking notes from your class. We teach in coaching. This is a skill that I think you need to learn first, and then you can hone and make it yours. But if you are the CEO of your business, you are not living today. Your mind is 45, 90, even 180 days in the future, because that's our business. It's the activities we do today that will show up later. Discipline again, right? When you have a profit and loss, you're tracking your numbers, you can see things before they happen, right? It's literally a crystal ball to your business. So I'll get off the soapbox on numbers. Everyone that knows me knows I love numbers, but this is the secret sauce to having a business and being a CEO. So you can be a realtor or you can run a business. And the difference is, do you track your numbers? And could you sit down with someone that wasn't in real estate, that was also a business mind, and explain your business? Explain the rate of return, explain time allocation, explain how things end up in your schedule based on what you're looking at in real time. That's going to impact you or your organization 180 days later. So on that, well, we're day 6 of this class. I've seen them all. I've been here. I've taken quite a few notes. I love our coaches. I love what they put together for everyone. If we could get in the chat, just thoughts on the class, before the end of the day, thoughts on the class, how it's impacted you, any major takeaways. Obviously, we want to know that we're creating an impact in changing lives, but where we're impacting you is where we can continue to grow and make these better. So please, 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 if you've been touched or you've had an aha or you've already implemented something, if you could share that today in the chat, that would be phenomenal.
Yeah, absolutely. And at the end too, we'll leave some time at the end for some Q&A too. So, okay, well, moving on here. So accounts that you want to set up. So this is just some tactical stuff for you. And like, I love going on webinars where I can have actually like, give me how to do it, right? And so when I look at this, I'm like, these are the accounts that, and there's a million ways I'm sure to do it. I just always try to find one that has worked and then just copy it. And so that's what I'm handing over to you guys is business savings. So have your business savings account set up. I actually set mine up in a Capital One account, which is it was separate from where I banked because I was too easy to move money back and forth when I overspent. And so I took the discipline and I created Capital One accounts because they were free. And then it takes about 3 days for that money to get over. So I couldn't screw up that bad, and have to overdraft fees. Did it a few times and it's not very fun. But that was always, so I had all of my money always goes into my business savings. All of my real estate checks goes in there. I keep 6 months of my business budget. I know exactly what my business costs each month. Ensure that sometimes there's fluctuations. Again, when you got, more listings or more sales one month, because just due to per unit costs as you're going up. But you can always adjust for that, as you know, and then put your business account in that. And that's going to also include what you're going to pay yourself as a salary. So treating it like you have a job. And we'll talk a little bit about why it's important to incorporate and what that looks like as well. But then I have a business checking account. So all of our business expenses go through that checking account, including my salary that will be paid out of that account. I now have a business credit card. I didn't for a long time because I wasn't disciplined enough to use it the right way. It just became my fun money. And so I now have a business credit card, so we get points and stuff like that, but I'm very disciplined with what I spend on that credit card. If you're not there, don't get a credit card. The worst thing ever is just to have your basic business account. It's down to $48 and you realize that I cannot spend any money in that account. Tax savings account. So talking to your CPA about how much you need to be putting in this account based on your tax bracket that you're in the current year. And that's going to be based on knowing exactly what your income and what your expenses are going to look like when those quarters are up. Okay. So again, I recommend meeting with your CPA 4 times a year, and that's so you can be really strategic with it. So those are the main accounts that I set up. This I have in like a Chase checking account so that it's accessible, but these are all in that my tax savings and my business savings are in a Capital One account so that I cannot easily access those. And that's just to hold myself accountable personally. So profit and loss statements, we touched on this a little bit here with profit and loss statements versus budgets and actuals. Again, profit and loss is going to tell you what you made and what you spent. Budget versus actuals is going to tell you what you wanted to make and what you actually made. and what you wanted to spend and then what you actually spent. So this is a great place for you to look. I schedule in my calendar once a month, usually by about the 4th or 5th of the month, to, again, usually on that first Friday, is I take that time and it's in my calendar and I look and I review it. And then I'm looking for anything that maybe isn't uncategorized or I haven't, making sure everything is properly categorized, I guess is a better way to say that too. And then really understanding what my ratios look like. So am I on track to have the profitability that I want? If not, what adjustments do I need to be making this next month to maybe my my lead generation goals again, or like what things could I be cutting out? What am I not using anymore? So that's a great thing to do once a month and put that in your calendar and be disciplined to look at that and analyze it every single month. So your financial team that you need, and I'm always a fan of, if you're going to go somewhere, you've got to go with the team. So looking at this and looking at your bookkeeper, that's the number one. So Josh, they use Palmer Bookkeeping, and I know that I'm not sure if they have an ad on here or how we're going to show them, but they've been around for a long time. They do a phenomenal job. They know the real estate industry inside and out. So instead of finding a bookkeeper that just does normal bookkeeping, go find somebody that specializes in this and does this for agents all day long, and that's what they're focused on. And I'm going to recommend that again with your CPA. And it's not just, does my CPA know real estate? Go find a CPA that is doing, it's a CPA for people that are high level teams that understand real estate at a high level and what you can do with a real estate professional tax code. If you guys want some recommendations, I have some great recommendations for you. So you'd be happy to shoot me a message afterwards and I'd be happy to give you some recommendations. An attorney, and why we say an attorney is because you want somebody that's going to also be able to help you set up your corporation. So being incorporated as a real estate professional gives all kinds of benefits. And again, you need to talk to you. We're not CPAs, we're not advisors. We're just going to, hey, go talk to these people and see if it's the right fit for you with your financial goals and with what you're making and what you're doing. I was always told if I made under a certain threshold that I shouldn't be incorporated. And what I've learned is that's absolutely not the case at all. So there's so many benefits to being incorporated. So you kind of really need to do your research and learn how and why, and if that's going to be a good fit for you. An insurance agent, obviously, because as we all know, we are typically most of us are not running businesses that do not run without us. And so usually for most of the people that are going to be on this call, if they stop working because they've gotten injured in a car accident or something like that, they are not working any longer. The income has stopped coming in. So making sure that you've got a really good insurance agent that's got everything protected, you've got all of your assets wrapped up in that. That's a really important one. And then a coach, a financial coach. That was, again, where some of my stuff really shifted. I still have a financial coach right now that's helping my husband and I and what we're trying to build get to the next level. And it's just amazing when you start surrounding yourself with people that have done it before you, how quickly your education and your understanding of how to build wealth can go up. So I always recommend those 5 people to have on your financial team and really have clarity on where you want to go and why. And then you get to kind of back that out into your business and your business planning. Choosing your business entity, again, as you guys are looking, I do highly encourage you looking into getting your business incorporated for just a number of reasons, from liability to taxes to just the ability to treat it more like a business and pay yourself a salary out of a corporation. There's just a lot of benefits that can come with it. And so there's 3 different types you can do. So proprietor, obviously an LLC or an S Corp. And so you need to be talking with your accountant and your attorney to really understand what's the best one for you for what your goals are. They all get treated a little bit differently, but I think it's really important. All right, so I'm going to try not to lose you on this one here. So I'm going to give you some really interesting just basics on taxes right now. And I know taxes are totally not a fun subject for most people, and I hated them forever because I was just frustrated because I'm like, I'm just writing my 30% check off to the government. And now that I've learned really how they work and how to use them, I don't want to say to my benefit, but to my benefit and to our family's benefit for wealth building, I'm like, I freaking love taxes and I want to learn more about it so that I can stop writing huge checks to the government and understand how to really transition some of that over into things that we can use to buy properties and to be building some passive income strategies for my family and I. So I'm going to talk to you a little bit about, I mean, there's some really basic things, but there was also some things I didn't know. So I figured maybe somebody else didn't know this either. So when we do our quarterly taxes, and sometimes as agents, we just don't even think about quarterly tax dates and why they're important, but they're actually designed because the government wants you to be paying as you're going and making money. So if you're in a normal job, you're getting taxes taken out. They will penalize you if you're at the end of the year and you haven't made any quarterly taxes, you get a penalty because you haven't made those tax payments for them to use during the year. So looking at these tax due dates, so April 15th, that's when we're usually paying for, like, we're looking at April 15th of next year. We're usually just so worried about getting our tax bill for all of 2022 in. But by the end of 2022, in January 2022, you should have already made your fourth quarter payment. You actually, in April 15th, should be making your first payment for your 2023. So I know, and this takes a little bit of time to get yourself caught up too. So don't feel like you're behind the wheel, but I want you guys just to understand what these look like so that you can start treating this like a business. So April 1st to May 31st, that time frame, those are due on June 15th. From June 1st, August 31st, those are due September 15th. And then from September 1st to December 31st, those are due January 15th. So that was just something that I really didn't know. I knew that there was quarterly tax dates, but I didn't really understand why and what the dates for what we were looking for during those timeframes are. So if you're meeting with your CPA, and this is the reason for meeting with them 4 times a year, as you're knowing on these dates what should actually be owed based on what you're actually making and actually spending. Okay. Looking here at the different types of tax. So we've got number one, as real estate professionals, we've got income tax. Obviously, we've got state and federal, and for depending on what state you're in, you could have no income tax. I know there's several states that don't have income tax. You have self-employment tax, and then you have regular employment tax, depending on if you are paying yourself a salary. So this was something that was also fascinating to me. And so again, I'm not going to try to lose you too much, but these are, if you are for the federal tax brackets for 10%, sometimes we hear, like, when our tax guy, we just usually hand them over everything. And then they're like, oh, you owe, you're in the 22% tax bracket. And you're like, okay. And so you think all of your money is being taxed at that 22%. And that's just not the case. So what happens here is, like, for us, I am married. And so for us filing joint, our first $20,000 that we make, 10% gets taken out for federal taxes. The next, from 20,000 to 83,000, that gets taxed at 12%. 83,000 to 178 gets taxed at 22%, and 178 to 340 gets taxed at 24%. And this is once you've gotten all of your deductions and all of your adjusted gross income. And what was important about that was because when I had it in my head was, if I was making 200,000, then I thought I was having to take out 24% for everything, and that's not the case. So you've got different tax at different rates of income as you're going up. Just because you go above that doesn't mean everything's getting taxed at that higher rate. Just the portion that's over, if you're making over 340, is getting taxed at 32%. Hopefully that makes sense to everybody. So state taxes, again, really similar. So this is for California, and I know you guys are all over the country. So same kind of thing is we've got these different brackets, and when they are at what percentages based on how much money your adjusted gross income is looking like here. So again, these are going to be based on whatever state you're in, or if you're single or married, they're all going to be different. But understanding what those look like is really important. So really talking with your CPA and getting a grasp on what that looks like. So then we have self-employment tax. We kind of forget about this part, but it's huge, 15.3%. So as self-employed real estate agents, this is what we are paying for. Since we don't have that taken out, FICA, if you're doing a normal W-2 job, you're getting all of those taxes taken out before you're getting your paycheck. So what we're trying to get you to start thinking about is, how do I start treating this like a job and paying myself ahead of time versus 10 months later, 12 months later, 18 months later, we're paying the taxes based on what we made this year. So self-employment tax here is at 15.3%. So just for your information, so 12.4% of that goes for Social Security and 2.9% goes to Medicare. super exciting. So what I look, I mean, this is kind of where my brain would go, is I was always so frustrated. So I was like, God, we just pay so much taxes. So if we're making 250,000 taxable income as a married couple, this is what we could anticipate owing. So again, we talked about these different brackets and what this looks like. So in this bracket, that first 20,000 was going to be taxed at 2,000. The 63,000 is going to be taxed there. So we're going to owe about 47,000 for our federal taxes. State taxes here, same thing. If we're making about 250,000, we're going to be owing about 17,960. So as we look at, then we've got self-employment taxes, we're looking at $103,000 total. Okay, so this is just rough. I'm not like, don't get too attached to the numbers on this, but I want you guys just to get a general idea on here of what our total tax would be owed. So that's looking at 41.5% of your income. That's huge. So when I look at that and go, those were just the painful, I'm like writing the checks, just going, God, there goes all my money. I'm just working to pay taxes half the time. It feels like, well, when you get into those upper price points and those upper income earners, you're paying a significant amount. And so I would get frustrated because I didn't want to keep paying that much money. And then because I was like, okay, now how do I save money? How do I save for my 6 months of reserves? How do I buy an investment property when all of this money is going out and I'm trying to just live and have our normal expenses? And so what I started really learning about and educating myself on, honestly, it started listening to Bigger Pockets. That was where it kind of launched from. There's they're kind of like a podcast, and they're a tech company, but it's all on understanding investments and understanding how to invest smarter. So this is really where I started looking at it, and looking at it from a real estate perspective, because they talked a lot about being a real estate professional. So being a real estate professional, what qualifies you as a real estate professional is that you have material participation in each specific rental. So if you don't own rentals right now, I want you to think about this as a strategy on how to, instead of paying that $103,000 to the government, how you take that money and you start buying real estate, and you can now create passive income for your future, to build assets and build passive income into it. So as a real estate professional, really, you're already considered, as a realtor, like just as a normal realtor that's out there selling homes, you're considered a real estate professional because that's what you do. That is your job. If you're a W-2 earner, there's some other ways you can make it happen, but it's a lot trickier. So we have this like kind of golden ticket that not many agents really even know they have, in order to be able to purchase real estate and use it to offset your income in your taxes. I'm going to show you how. And this is going to be something that, if you want to reach out after, and we go into a little bit more detail, not a tax person, but I can definitely steer you in the right direction to get the right people that this is what they do all day long. So you've got to have material participation in the rental, or you've got to have material participation in a separate real estate property trade or business. And that's what we do as agents. So that's what qualifies us for this real estate professionals designation with the IRS tax code. So I'm going to give you guys an example here. And this is something that blew my mind probably about a year ago, was when I first started learning about it. And then I dug into it more and started listening to more and more podcasts and really understanding it. Now we're using it in our own, we already own some properties. And so we're using it in our own tax strategy on how do we, this year, we literally will not be paying taxes due to some of the laws that have been put in place, and all legal. It's all legal. It's all within the tax code. It's just understanding how to use the tax code to your benefit. So I'm going to give you guys an example here. So Sue and Dave made $250,000 taxable income, in which they would roughly have paid $103,000. So I'm using the same example as what we just went through. So in 2017, and whether you like them or not, I don't really care, but Trump had put in what's called the Tax Act of 2017. And why he did that, he's a real estate guy, right? Like that's what he does. So everybody would always scratch their head and go, how does he only pay $750 in taxes? Like there's no way. He has significant losses. This is how he does it, because basically what you can do, he created a tax act where in a normal property, so what we're going to look here, a normal property, if you purchase it as a rental property, you're going to depreciate that property over 27 and a half years. Okay. So what that means is on your tax return, you file what's called a Schedule E if you have rental properties. And what those say, they say, okay, your rent, let's say, is, you know, you've got your income from your rent, you've got all of your expenses, and then there's a line item called depreciation on there. What the government allows you to do is depreciate that asset over 27 and a half years. Why 27 and a half? I have no idea. But they allow you to do it over 27 and a half years. So a lot of times that will, you know, if you've got a property, you can only write off the building portion. So let's just say, for instance, we have a $400,000 property. The land value is 125,000 and the building value is 275,000 for easy math. You depreciate that over 27 and a half years. So really you get a $10,000 loss on that property each year. That can actually go against your income, which that's super helpful in reducing your taxable income. What they did in 2017 is he put something into place called bonus depreciation. So really what that allows anyone to do is if they're putting a new property into service, you do what's called a cost segregation. So they come in and instead of depreciating that property over 27 and a half years, I don't want to try to lose you here, but instead of depreciating over 27 and a half years, they take all of the assets inside of the house, like flooring, carpet, you know, cabinets, light fixtures, all the stuff that is part of the building, not the structure itself, but it usually typically equates to about 30% of what's in that property. And instead of depreciating that out over 27 and a half years, they're allowing you to write that entire amount off in year one. So when you're looking at that, so as you're here, let's look at our example here. We're purchasing a $400,000 3-bed, 2-bath home, right? We just talked about, it doesn't matter what kind of bedroom, bathroom, for easy math. We put $100,000 down, so 25%, right? And that's also about, like, when you look at this and you say that's about what I would have paid in taxes this year, right? So my taxes I was going to owe was about $103,000 in our previous example up here. Our land value, like we said, was 125. Building value was 275. Normally we depreciate that over 27 and a half years, like we just talked about, $10,000 a year. Now we can use cost segregation to write off many of the depreciable assets at an accelerated pace, typically between 5 to 15 years. So that's about 30% of the total value of building. What they're allowing us to do right now, though, is take that whole amount and write it off in year one, which would create a massive loss against any income that would be coming into the property. So we've got income minus expenses, minus this huge amount of depreciation now that we can take in year one instead of spreading it out over 27 and a half years. So as we're looking at that would actually equal about 82,000 that we can now take off as a loss. And because we're real estate professionals, we can take that off as a loss against our real estate income. And why this is so important, you guys, is because if you look at that and go, gosh, instead of paying 104,000 to the government, I can now write that amount off and my income is going to drop significantly. So my taxable income is going to be significantly less. The government's, like, in theory, kind of paying you to be able to purchase properties and write that off and use that against your taxable income. And why would they do that? Because the government they need our help in helping people to create more housing opportunities for people out there. The government can't create them all, right? So they're incentivizing us as, you know, I think they give us as a real estate professional a little added bonus there because they're like, hey, these guys know what they're doing. This is what they do all day. Let's give them an added bonus for this additional depreciation. And then what we also have is what's called cost segregation. I know we went through that a little bit, and I can go into more details. I mean, it's pretty intense. So I'm trying to just kind of give you a 30,000 foot view of this. But if you already own properties, you can do what's called cost segregation analysis, and they can accelerate your depreciation right now at a accelerated rate of 5 to 15 years versus 27 and a half years. So that's really how we're able to this year not have to be paying hardly any taxes because we're doing cost segregation on all of our properties. So I know that feels like a lot, but I think if I could boil it down to like the basics is as a real estate professional, you need to be buying real estate, and you need to be connected with a CPA that knows what they're doing and how to use the strategies in the tax code to help you offset not paying as much in taxes and helping you build wealth. So hopefully you guys stuck with me through all of that here. We're talking through cost segregation. Again, this is what we just talked about. You know, if you currently own them, they're on a normal, we can do cost segregation. And the most important person is your CPA. Really, that's what I've learned more than anything. It's not just somebody that does my taxes. I'm not handing over a bunch of receipts. There's somebody that I'm being, we're strategizing together on building wealth. And because of my designations as a real estate professional, and probably yours that are on this webinar, you can do that too. And that's what's so exciting, is that there's actually opportunities where we're not just giving all the money over to the government. They're actually incentivizing us to go build more wealth and go build more properties and go create more housing opportunities for people. So this is kind of I can be happy to send this out at the end. This is kind of an action step for you as you go through these with all the things we talked about. I mean, we just talked about a ton of different stuff in this last 53 minutes. Hopefully you guys got some nuggets out of it and we didn't go too fast, but this is being recorded. So if you want to go back, and then I've got some other awesome recordings, if you guys shoot me an email or whatever, I'm happy to send out some more information to you about that stuff. But one of the most important pieces, I think, is just really understanding, you know, as you are creating, you're in this business because you got in for the freedom and flexibility. And yes, it absolutely offers us that. Now it's saying, how do I start treating this like a business so that I can go and start creating a legacy? Not just that I'm going to go just keep selling house after house after house after house. That's the goal. And so I really want you guys to think about, you know, just how do you start building this out? How do you find the right partners, people to partner with? How do you start understanding where do you want to be in 10 years or 15 years? And if selling real estate is in that plan, amazing. But then how do you use real estate as a kind of a gateway also to helping you build a retirement plan and getting you at a path where you can have some passive income and have your choices. So that's it for, you know, a whole 50 minutes of a whole lot. So I've got a ton of questions in here. I'm going to just go down here. Let's see. I'm going to go through some of these questions that are in the chat here. So Profit First book is a great book for this as well. Yeah, there's so many good books. I've got some questions there. What are some books that you like? And one of the most important books I read was called Millionaire Mindset, and it was all on like kind of your blueprint about your money and how you spend your money and what your thought process is on like how you grew up with money and what emotion was tied to money. And that was a really cool one. I love that one, but I love doing financials with agents, and I love doing financials with teams and really getting them to understand what their ratios need to look like. So it's just continuing to educate yourself on anything. There's another great one called The Psychology of Money that's awesome. Jason Northcutt says, thoughts on an S Corp? You're an LLC now. I'm actually an LLC, but treated as an S Corp. So you can talk to your accountant about that. There's a reason why, and I know enough about it to get in trouble. But S Corp obviously allows pass-through and some different things. There's different reasons for setting things up differently, and I don't want to get into any of that on this call because it's really designed for you to talk to your accountant and your attorney and about what your goals are and how to structure that the best for what your goals are. But there's a lot of great stuff that can come in with liability protection. Let's see. Yeah, don't want to be a realtor all my life. Want to be a business owner. That was me too. Like I like selling real estate. Real estate is awesome. But yeah, I think it's all about now how to treat it like a business. So let's see here. CPA recommendation. Yes, I can put that in the chat here. What happens to depreciated value if you were to sell it inside that 27.5-year depreciation period? Well, that's just with anything. If you're asking, the question was, what happens to that depreciated value if you were to sell inside that 27.5-year period? You're always subject to the recapture tax. And I would say it's subject to a tax because really one of the best strategies is just deferring. And so that again comes down to you talking with your accountant and figuring out what that looks like, and possibly just kind of, we call it kind of kicking the can down the road, but deferring those taxes, because there's a strategy like we're using right now where our goal is to just continue to roll them into 1031s into different properties And then eventually our kids would get them with the estate tax, hopefully being that you're talking about, raising it back up to like 20 million or 15 million or something like that, that at that point, then they would get those properties when we die and not pay anything on those and not pay any taxes at all. That's our goal. Let's see. An example of the accelerated depreciation, what would be the person's tax bill after the purchase? I'm not sure I follow that question. So if you want to rewrite the question, I'd be happy to try to answer that. And then Nico says, so essentially 1031, everything until you put it in a trust and call it a day. Yeah, I mean, it's kind of the government's going to want their money at some point. So how to be strategic about it. And again, that's why each person needs to kind of have their own plan on how to do that and what that looks like. So everything gets taxed differently. Your capital gains gets taxed at a different rate than your recapture tax. And you can talk to your accountant and your CPA about that. So there's a lot of nuances to it and they will change. So again, finding a super educated CPA is really the biggest goal. And then having them as not just somebody that does your taxes, like thinking differently about it and going, how do I help them kind of create wealth with me and use them as long as they understand the tax codes and how to use that to your benefit. So, all right, any other questions? Let's see, I think we meant after 80,000 gets appreciated, what is the tax liability in the example you talked about? Really, like, and again, that just has to do with depending on how big your tax liability is, you're going to have your Schedule E, and that's where you have all of your losses for your rental properties. So if your income from the rentals is, let's say it's 2,000 a month, so it's 24,000, your expenses after your mortgage and property management and everything are 24,000. So normally, let's say it's right now, because there's not a lot that's out there that's making a ton of sense. Like, let's say it would be normally a zero. Then you're going to put that 86,000 that you're going to be depreciating as a loss. And so now you have a true $86,000 loss against your $250,000 income. So that reduces your taxable income down. You can buy a bigger property. You could 1031 your properties into, you could 1031 two properties into a big property, and then you're going to have a whole lot of losses that maybe you could even carry forward into the next year. So again, talk to your CPA about it. I just want to be educating you guys that this is out there for us as realtors, because nobody's ever told me about this. I had to kind of go dig it and figure it all out. And yeah, it's been awesome. So Andrew just says real quick, can I do cost segregation on property that I've already owned for 5 years? Yes, you can. Absolutely. Yeah. Yes, correct. Nico on that. I think so. Yeah, I don't know. Yeah, I'm and thinking at the same time, which I'm not great at. Yes, you're right on that one. So just trying to get the goal being, I want you guys just to look at this as a concept and then really look at how do we treat this like a business. So I think we're going to wrap it up unless we've got any other further questions. And then if you guys are looking for coaches to really help you take your businesses to another level, I want just to really encourage you to reach out to Rieger. And this coaching company does such an amazing job with all, teaching you guys really how to run profitable businesses. You guys have seen over the last few days, you're going to see for the next few days on really how to start, continue to create more business. And then now that we've got that business, now how to turn it into something that you can take with you and not just, something that we go spend more money on. So I'm going to let's really quickly share the screen one more time and give you guys for the rest. Let's see it. Our last slide here. So if you guys do need a coach, if you're not currently with us, you can do a free business consult here just by scanning this or visit riegercoaching.com. And thanks so much for joining us today. And I hope you guys got a lot of value out of it. Have a wonderful, amazing day. Happy Halloween too.